wanted to give the panelists here just an opportunity to introduce themselves as well. We are just so grateful that they took the time out of their busy schedules. We have an unbelievable group of people here, and I want them to just take a quick moment to introduce themselves as well. So, Patrick?
My name is Patrick Trolli. I'm a partner at the law firm Wilson Sonsini, Goodrich & Rosati. I've been practicing corporate securities laws for 28 years, all at Wilson Sonsini. I'm the head of the Seattle office. I was the longtime chair of the capital markets practice at Wilson Sonsini. I've done a lot of work in Utah over the years. I represented Omniture in its IPO 11 years ago now. Represented Fusion IO in its IPO a number of years ago, and represented them all the way through their sales. I continue to do a lot of work with Utah companies. I do a lot of work with Sorensen Capital. I represent Domo. I represent Experticity and a number of other companies as well. And I'm delighted to be here.
All right, Melissa.
Hello, I'm Melissa Knox with Morgan Stanley. I'm an investment banker in the technology group covering the software sector. This is my 12th year in investment banking. I work with companies on IPOs, private capital raises, debt financings, and M&A, all across different areas in software. I cover a number of companies out here in Utah. I'm based in San Francisco, but I feel like I spend about half my time out here. I know a number of you in the audience, excited to see you here. I was the lead banker on Instructure's IPO at the end of 2015. And spend a lot of time with the private companies out here. So thank you for having me out today.
Thanks, Melissa.
Magdalena Nam. I'm with the New York Stock Exchange, based in Silicon Valley, just like Melissa. I help run the technology IPO practice for the NYSE with a special focus on consumer and financial technology. Based in Silicon Valley, but have had the privilege of working with companies across the globe pretty much, including some fantastic companies coming out of Utah, Vivint Solar, Instructure, just like Melissa. And prior to the NYSE, I was an investment banker, technology investment banker at Credit Suisse. 8 years, spent 8 years there helping companies with fundraising and IPOs. Over the past 7 years at the NYSE, it's just been phenomenal. When I joined, we were listing 10 to 15% of all technology IPOs that were coming to market. I've had the privilege of working with some incredible disruptive growth stories, such as Pandora. I think they were here at the conference. Twitter, Yelp, LinkedIn, Workday, Square. That was phenomenal as well. So now we are the new destination for technology IPOs. It's incredible to be here in Utah. I'm sure I will be spending even more time here. The caliber of sort of the next wave of innovative companies is just phenomenal. Pluralsight, Domo, Inside Sales, Qualtrics, just to name a few, the list goes on. So thank you so much for having me.
Thank you. David?
Great. My name's David Jolly, and I'm one of the managing partners for the West region with Ernst & Young. And before that, so I've been doing that. I'm out in Silicon Valley. I'm in our San Jose office. Before that, I was the managing partner for Ernst & Young here in Salt Lake for a long time. And I think if you look back, I think I've done most of the technology IPOs in Utah since Omniture back in 2006. So I've been a part of this, and whenever there's an opportunity to come back to Utah, I jump on it. So that's I'm happy to be here, and I'll just put the endorsement on this panel. I've got a philosophy that if I hang around with really smart people, eventually it's going to rub off on me. So this is a great panel.
Well, thanks, David, and welcome home. So let's get things kicked off. So 2016 was just not a very thrilling year on the IPO front.
No,
and you know, it seems that in 2017 people have high expectations that this will be a big year. There's rumors that big tech companies out of the valley, tech companies even here, are waiting in the wings. What's the view of the markets for 2017?
Perhaps I can start. You're absolutely right. 2016 was dismal, and not just for tech IPOs, but IPOs across the board. I think largely because of geopolitical factors. I'd be curious to hear what you think as well. All the uncertainty around the election was just not good for volatility. We had Brexit, which led to volatility pretty much spiking up at the end of the year. That said, capital markets are incredibly forgiving. So we are really constructive on the outlook for 2017. Our president is in Davos right now, and he just spoke about this. Some of those topics that are really important to our listed companies, and I think they're very important to IPOs as well, such as just the deregulation, the need for that, tax reform, which everyone's looking forward to. So I think those are drivers that would really propel IPOs going forward. There's pent-up supply, and I think investors have a lot of appetite for really good growth stories. As we can tell from the fantastic returns of those few IPOs that went public in 2016, I mean, the returns were just incredible, especially relative to 2015. I think 15% and more, over the S&P 500 versus I think IPOs underperformed the S&P 500 in 2015. So we're very optimistic. I don't know if there's wood here. I'm knocking on wood. I mean, what we fear is what we don't know. I mean, there could be a big black swan event that could impact things. But, that said, I think we'll see a steady and increasing supply of IPOs as we approach year-end 2017.
Melissa, it'd be great to get your perspective as an investment banker.
We have got a large pipeline of IPOs waiting to get out in 2017. I think one of the things about 2016, there were a few IPOs, but there was a lot of M&A. And what that did was take a lot of investable opportunities out of the market for the buy-side investors. So Fidelity and Wellington and Putnam, all these guys can no longer invest in these companies that used to be public and have now been sold. And so there is huge demand on the part of the buy side to invest in IPOs. In 2016, there was a big valuation disconnect between what private companies thought they were worth and what public investors were willing to pay. And you saw this beginning in the first quarter of 2016. A number of public software companies missed guidance, missed earnings, and it took down the software index, the tech index, throughout the majority of the year. So they were coming in off these depressed valuations. They had raised money in 2015 at the height all-time height of valuations, and they weren't going to go out at significant down rounds. And so you saw this big valuation disconnect that started to decline toward the end of 2016, and now there is more of an alignment between public market and private market valuation expectations. And so we see these companies getting ready to go out. We've got a solid pipeline of IPOs to get out this year, but I also expect M&A activity to continue. I think that's one of the topics we'll hit on. But we're on the road with AppDynamics right now, which will be it will be the first software IPO to get out this year, doing really well. We can talk about that when it'll price next week, but high demand for that company. And that'll be kind of a barometer for software IPOs in the first quarter.
Any announcements about Utah companies that are going this year?
I have nothing to say about Utah companies going out this year. I think there are some quality companies out here in the audience that could absolutely get out this year. I am extremely bullish on the Utah market. This is really the next Silicon Valley. This is where we, Morgan Stanley, are spending a lot of time. I mean, if you look at what does Utah have to offer versus Silicon Valley? A really good employee base. These are extremely strong employees. You've got talent coming out of the universities in Utah. They're loyal to their companies. They want to live here. They want to stay here. And you've got a lot of technology engineering talent right here. So, A number of the companies we talked about could absolutely get out this year. One of the topics we'll talk about is, should you stay, should you go? What's the benefit of waiting versus going now? But if these guys wanted to get out, they absolutely could.
So what are the typical attributes of a company in terms of, a company that's ready to go? And maybe David or Patrick, you could talk about just from a preparation standpoint, from an infrastructure standpoint, and from a process standpoint.
Sure, I'll start off with a couple of things and then toss it over to Patrick. I think that one of the things, given the volatility that we expect to see as we look at the IPO market for 2017 is the windows to go public are going to open and close quickly. So there'll be compressed windows. And because of that, companies really need to be ready. They need to have all the people and the processes, the financial systems in place so that when that window opens, they're ready to go. So I think it's probably incumbent on companies more now than ever to really have their financial house in order. And by that I mean, all of the accounting, the financial reporting, and going through and doing, mock quarterly releases and going through a script of what an earnings release might look like. Getting to that cadence and really, being ready. So from a financial perspective, those are some of the things that we see. Patrick?
I think, as a lawyer, I look at the specific legal requirements first, and those are pretty kind of easy, and you can look at those. It's audited financial statements and having a board that is a majority independent and things like that. Those are relatively cut and dry, and they're easy to see and to check those boxes. They're not easy to do, but they're easy to identify and say, okay, we need to get a majority of independent directors and so forth. But doing it right is easier said than done. So getting a board of directors that can actually support the business and can grow with the business, and recruiting directors who know what it's like to be with a growing company, to know what it's like to be with a growing company that's under the scrutiny of the public shareholder base is really important. Because quite frequently, and I say that knowingly hearing you talk, quite frequently you've got management teams that maybe they've done an IPO or been a senior executive in a public company once before. Quite frequently, it's not at all. And so putting a board behind them that can give them the wisdom and the guidance to not falter when they're a public company is really important. Not to mention the fact that the investors are going to look at the board of directors, and they're going to, in conjunction with the management team, and say, is this somebody that we can trust with our money? The other thing that I think is easier said than done is having a business that's mature enough that you can predict it. The lawyers are worried as hell about the company making its projections as a newly public company and then missing those projections, whether it's missing it on the revenue line or even worse, missing it on the expense line because he didn't have his handle on the expenses. So just as Dave talked about doing a quarterly close and quarterly earnings release and as a dry run in the year or so leading up to an IPO, really looking hard at your models and your ability to project your business and how you're going to guide Wall Street, and having a high degree of confidence in that is really important. You do not want to miss a quarter in the first 12 months out of the gate. You're going to get sued, and that lawsuit's going to have legs.
And actually, 1 in 4 companies misses.
Absolutely, absolutely. You don't want to be that one. And so I think and projecting your business is not an exact science, but understanding where the dials are and understanding what your weaknesses are and understanding where you need to improve is essential.
So is there a single most important element to a successful public company? If you think about growth, profitability, business model, some combination of those, there used to be this mindset in tech that, hey, it's growth at all costs. We know that public investors are demanding a path to cash flow and profitability for those businesses because they haven't seen it in some of those models. I mean, what's the perspective of the panel on, is there just one single element that's most important for a company to focus on?
I would say no, and I mean, it's growth versus profitability. It's a long-standing debate, and we all remember the bubble days of it was actually acceptable to sell $1 for 85 cents, but those sort of days of profitless prosperity, if you will, are behind us. And I think the pendulum has definitely swung, and it's somewhere in the middle. And I would say that it's really, from my point of view, it's really sector specific. I think in software, and I think Melissa, you can talk about that. I think is the focus on profitability from an investor's standpoint is definitely there. In consumer technology and internet, which is what I'm focused on, I think there's a little bit more acceptance of sort of lack of profitability, but definitely focus on unit economics and this path and trajectory to profitability that just has to be there. But I think overall, the recognition is definitely there that all revenue is not created equal. So I think what investors continue to focus on is the defensibility of the business model. Are really the competitive advantages and differentiators there? Are there network effects? All of those things that really make a great company.
We put together an analysis of these 4 areas. One is business model, scale, revenue growth, and profitability. And we looked at all public companies out there. And everybody around the perimeter has one of these different attributes. And as you start to come into the middle, you have this little group of companies that has a combination of scale, growth over 25%, profitable, and a predictable business model. There were 16 total public companies in that middle sector, and these are the most highest valued companies out there today. It's very difficult to achieve all 4 of those things. When we started digging into this even more, the number 1 driver of value was business model. And that goes along with the predictability of your revenue. So why are all these companies moving to subscription-based models today? Well, a lot of reasons, but one of the bigger ones is I have predictability. I have deferred revenue. I have backlog. I know what I'm going to do next quarter. I know what my next 3 years are going to look like because I have this big backlog of 3-year contracts. And so business model really drives value. And then when it comes down to kind of this, the valuation at which you go public and your trading valuation, we look at Rule of 40. I don't know if you guys have heard this term before. It's the combination of revenue growth and free cash flow margin. And so the combination of those 2 metrics is really highly correlated to revenue multiple. And revenue multiple is what most tech companies are valued on today. So, it's one or the other. We want this balance of growth and profitability. But no, I think the public market investors are more willing to see unprofitable companies again, as long as we can start showing metrics that you will get profitable within the next kind of 4 to 6 quarters.
So we know business model is very important. I've seen that graphic, and there's a stark contrast. You have to nail business model. Along those lines, and David, you touched on this a little bit, some of the operational changes that need to take place in terms of forecasting the business, going through those earnings calls, but that has a spillover effect to other areas of the organization, because usually those finance teams are just collecting data from other parts of the organization. So what kind of operational changes does an organization need to go through to go through that readiness project to be successful as a public company?
Yeah, so let me come at that from a little bit different angle and just kind of piggybacking on what was said. Whether it's profitability or revenue growth, it really is dependent. Snapchat, that's all about revenue growth. A company like Ancestry.com, it's all about free cash flow. So, but the thing that you do have to understand is what are the metrics that drive your business? So I'll pick on some of the sponsors. So Vivint, it's all about retention, client retention and churn. For Ancestry, that's a metric that they report every quarter. So when you think about those operational aspects, you better have the right systems and processes in place to gather that information that's reliable, that's consistent from period to period, and to be able to pull that information so that whatever those metrics are that you're going to report on, Because the thing that's interesting is, when you're a public company, you may beat your revenue forecast. Well, if churn is higher than you expected it to be, you're going to get slammed. So they're going to look at all of the street's going to look at all of these metrics, and so you really have to have a solid understanding of all of them. So again, I hate to say it, but it keeps coming back to you've got to have those processes in place to capture that and be confident about it.
And that really gets down to unit economics in the end, right? Those unit economics that tie into that model, really understanding those drivers of your business. So, what are the advantages of going public versus staying private? I know that's an open-ended question, but maybe we could take this just initially from kind of a compliance perspective as well. But I think there's a branding component and things we want to touch on here as well.
So I'll start. Clearly, there's an opportunity from a branding perspective. If you're a public company, you're going to be at some level better known than if you're a private company. That's a double-edged sword, right? Because you're going to be better known, but your competitor is going to know your financial information. They're going to know your margins. Your competitors for talent are going to know elements of your executive compensation and who owns what of the company. But there's more information out there which has a tendency to give you more credibility with customers. Obviously, when you go public, it's a financing event, okay? And 90+% of companies actually raise capital in an IPO, and so you've got a stronger balance sheet as a result of that. You've got a currency as well that it is easier to use if you're doing acquisitions. As a private company, very hard to do a stock acquisition. Not impossible, but hard to do, complicated. Much easier to do if you're a public company. Easier to value it because you've got a trading market for the stock. Easier from a legal compliance perspective to issue the shares to the shareholders of the target company. So those are a few benefits.
Any other perspectives there?
I mean, sure, I'm obviously very partial, so would certainly like to emphasize the branding component, because I don't think many people realize that the exchanges can be very helpful in that respect when it comes to listing day. And whenever I talk to companies, I realize that very few people know that the NYC, for example, is arguably the largest television studio in the United States. So literally, as part of listing day, we physically put you in the spotlight, and it creates incredible opportunities for just companies' businesses. And we did that for Instructure, for Vivint Solar, and so forth. So definitely, I would say thinking about that and how it can be leveraged in terms of growing the business is a good thing to consider.
Yeah, are there certain companies or industries though that branding event is more meaningful? Is it meaningful to all of them?
Absolutely. So I would say consumer-centric companies, it's paramount. And on the B2B front, it's also a consideration. It's really helpful, especially with Silicon Valley companies. The war for talent is very well known. So even sort of creating visibility with employees, with prospective employees, is very, very helpful. But it's definitely sector specific. I would agree.
So I know at one point in time, and maybe this is gaining popularity again, evidenced by some of the M&A activity that we saw last year, but companies at one point were dual tracking their business, really with the intent of driving up the price, because they wanted to have this credible threat of going public, but they never really wanted to pull the trigger and have, and they never really intended to list. Is that something that we're seeing come back as a strategy right now?
Absolutely. We lost two of them. Melissa worked on those, so I think she can talk.
Yes, here we're antagonistic about what the outcome should be. So yes, we saw the return of the dual track in 2016. We did 2 dual tracks, one for a company called Optiv and one for a company called Blue Coat. And these were textbook dual track processes. And so dual track means you are going to run an M&A process in parallel with an IPO process. And you want to use the public filing of a prospectus as a triggering event to get somebody to bid on the company, and you have this good alternative out there, you have a very credible alternative of going public. And so that is the threat to a potential buyer. I don't want this company to go public and shoot up in stock price. I want to take them out now. And so we run these processes in parallel to try to extract as much value as we can from a potential buyer while we're holding this prospectus out here. And you run them in lockstep with Optiv and with Blue Coat. We announced the deals, and if we didn't announce those deals, the very next day we were set to hit the road. We had everything lined up in New York to launch the road shows.
Opening bell was secured on
We
our
had
side.
road show presentations set up to go, and we asked for final bids and signed a deal. So we've seen it happen, and we are absolutely advocating dual track processes in 2017. Think about, I'm looking out at, I don't know how many companies are represented out here, but my guess is that the majority of the companies out here will probably go the M&A path over the IPO path. And you think about the strategic value that you can add to, in the software space, is it Microsoft, Google, Oracle? What is the value that you're going to add to one of these companies versus the value that somebody like Fidelity or Wellington is going to see from the company? And you start doing a valuation exercise, and sometimes that strategic value is so much greater than the public markets that you want to take that outcome. And I think with Jobs Act, which has shortened the time from where you have a public document on file till when you're actually public, has made it more difficult for you to get acquired just randomly in this kind of 2-week process. And so we are much more aggressive about going out and kind of testing the M&A path at the same time as the IPO path. There's no harm in doing that. You have a very credible public market alternative, so it doesn't seem like the companies on the block or for sale or damaged. We're out there saying we're going to take them public. And so we see very little downside in testing the M&A market at the same time as you test the IPO.
So I think Melissa talks about it, she can mention Blue Coat and Optiv because of the result. I think it's safe to say that for the companies that have actually gone public, have completed the IPO, it's probably a pretty safe assumption that somewhere in there, the bankers reached out to a group of selected buyers and said, hey, and conducted the dual track and said, hey, you've got an opportunity to preempt this IPO by putting an offer in. And for whatever reason, the company decided, those offers did not come in, or they came in at values that the board of directors decided didn't make any sense to sell. They'd rather roll the dice and do the financing and continue to stay independent. And so, and those are the deals you can't talk about, right? You can't say company X, which did an IPO, was ready to be shopped or was shopped to X, Y, and Z. The lawyers and the bankers and the auditors can't name those because they're public companies right now. But I think it's a safe assumption that those were also dual tracked at some level in order to preserve optionality for the board.
David, do you think that it's an efficient way to go?
Yeah, let me just tell you a quick story, and it's no longer public, so I can tell the story, I think, according to Patrick. You can sign off on this. But, so
You want to whisper in my ear first?
that we took public in 2011, Skull Candy. Most people have heard of Skull Candy here up in Park City. So, they started down their IPO path, and sometime in the fall. And I got with Rick Alden, many of you know, unique personality. I said, Rick, you really want to be a CEO of a public company? He said, no, we're just going to dual track and we're going to sell the company before we go public. And so I said, okay. So over the holidays, they asked the bankers to go out and shop it. So they went to 20 different potential buyers. They got one offer. They said the valuation's too rich for the IPO. We can't compete with that. So they came back, the bankers came back after the holidays, and it was like, all right, Alden, buckle your seatbelt, we're going public. So it didn't play out the way that they had planned.
Dave, I'm sorry, you can't tell that story.
Okay, is there any Skull Candy?
Well, very good. Well, we wanted to leave a few minutes for questions from the audience here as well. We've got about 7 minutes left, and please take advantage of this time. We have a wealth of knowledge up here on this panel.
I have a question for Melissa. So, in the last, beyond 5 years ago, there was a group of investors that would buy IPOs, okay? And then over the last 2 to 3 years, we've seen those investors get in like Uber and Airbnb as private companies. So is that group of, and they've gotten burned, some of them have. And so is that group of investors, is there gonna be a group of investors to buy IPOs? Or did they all get in on the private rounds? And so I'm curious about how that's gonna play out.
So did all the investors get in on the private round so that they're such that they're not going to get on the IPOs now?
Yeah, essentially.
Yeah. No, I don't think that all of the investors have been burnt and are kind of out of the market because they've invested in that category. Investors are far more discerning now in those private the private investments that they're making. And, let me just talk a little bit about that. So 2015, I think we talked to a lot of you guys about going out and raising capital. We did a lot of private capital raising. We raised money for companies at, kind of all-time high valuations. 2016, valuations came back down. These public market investors had to take some pretty big write-downs on their investments. They're now starting to come back up. These guys are now just being very careful about what they're putting money into. I'd also say that those same type of investors structured a lot of those transactions such that they get a ratchet. They get one time their money back in an IPO or in a sale. So they're protected. It's great for them. It's harmful to a company. So think about this when an investor throws down $2 billion on the company. Oh, that's great, but we want 2 times our money back, or we want 1 times our money back. If your company really is nowhere close to that value, and you want to go public in the next year, you're going to get an offer in for $1 billion because that's truly the value of your company. That value to you is now $750 million because you've got to give money back to that investor. So there is a cost associated with that. So be aware of that for all of you that are kind of thinking about.
So with those ratchets, are you seeing that as a deterrent as well? Like, are the public investors looking at that and saying, we don't agree with the value that was put on the business in their last private round, so we're just going to value it the way that we think it ought to be valued? I think I hear you speaking to some of that.
Yes, we are seeing that. And, App Dynamics right now is, they're kind of straddling their last round. The midpoint of the range is right where their last round was done. There was a ratchet on Instructure when we took it out. There were ratchets on a lot of these new companies going out, and investors are saying, I don't care. I'm going to value you based on where I think you're valued today. And if you don't want it, I'll wait. I'll wait until you go out. You prove a few quarters that you can execute, and then I will come in. And that's what we're seeing more of today, to your question, is that some of these investors are not coming in on the IPO. They will wait to say, your business model is not right. I think you're going to miss. So I'm just going to wait. I'll wait 3 quarters out to see if you can really do it. And even then, I think it's going to be at a good price for me. So I'll stand back.
So, Dave, to answer your question from my perspective, now I've been fortunate in that for all of the unicorn financings I've done, I've been able to avoid ratchets and blocking rights because there's 2 things there. One is the ratchet that they might have in an IPO. Another is their ability to block it. Even if they don't have a ratchet, they might exercise. I've been able to avoid those for my clients.
Do you mind explaining some of those terms for the audience?
Sure.
Here as well?
A ratchet means that if the IPO or any follow-on financing is done at a price that is lower than the price that the big investors paid, then the investor gets for nothing. They get an adjustment to their to the number of shares they own, so that they get the economic benefit of the new price. So that basically their old money gets revalued into the new price, and they get a bunch more stock. Okay, that's a ratchet. A blocking right means in the event of an IPO, most of the time, the outstanding, the shares owned by the investors automatically convert into common stock, so that there's only one class of stock outstanding at the time of the IPO. Oftentimes, an investor that's paying a very high value will say, my shares don't automatically convert unless the IPO price is X times what I paid. And if you can't get that, then that investor has you over a barrel. You've got to negotiate with that investor and pay the piper in order to let the IPO go forward. I've been lucky, Dave, that I haven't had to give up those rights. Some of my clients have actually traded valuation and said, we'll take your money at a lower valuation than you're offering, but we're not going to give you those rights. The 2 IPOs that I did late last year did have the Fidelities and T. Rowe's in them. And in one of those 2 cases, the IPO price was actually less than the last round than what they had paid. And they invested anyway. They were dollar cost averaging. They were saying, look, we were able to buy a big chunk before the IPO. We're going to buy another chunk at the IPO at a lower price. We're dollar cost averaging down, and we still think, even though we're paying our initial investment did not appreciate, we still believe in the company, and so they're going to do it. In the other case, the price was higher, and they were also buying. So,
and just to actually add to that, from my standpoint, we actually did an analysis of Fidelity's OTC fund just last week, and looking at NYSE-listed IPOs that they had invested in prior to the IPO, and then looking at whether other Fidelity funds had stepped in after the IPO, and up to a year after the IPO. And what we found out is that that initial investment was actually just a small fraction of the investment of 9 to 25 additional Fidelity funds that had gone in post-IPO, and Twilio was a great example of that. So I know we really are laser focused on the IPO, but let's think about the long term and what happens.
Yeah, I'm shocked, Greg, that nobody has any questions about internal controls.
yeah.
We got like a whole half hour on that.
That's right. That's right.
Let's go.
Well, yeah, go ahead.
I've worked with a lot of fast-growing companies and CEOs as well as public companies. I wonder what advice you have regarding sustainability in looking down a year or 2 after an IPO, over and above your business model and kind of having all your controls in place. What advice do you have in terms of how we think about making sure that we really have sustainability as a public company, so you just don't get murdered down the road in terms of the public investors?
Melissa, do you want to take that one?
Sure. I think you have to have confidence in your model. So build up a model at which you're able to predict out. We guide companies on a 2-year forward model. So at the time of the IPO, we will help you we'll give you guidance into every single quarter for the next 2 years. And we will help you with your bottoms-up plan, and then we will help you with a beat and raise plan. So here's your internal plan, and here's the plan that you should follow, such that you can go out and beat and raise and beat and raise and beat and raise every quarter. And what that means is that you go out to the public with a discounted number versus your management plan. So your management plan might say, we're going to grow 50% for the next 2 years. We're going to commit something to the public, and you should think about this as you think about a public market value. It's not based on your management plan. It's based on the model that you give to analysts, which is usually at a pretty big discount to your internal plan. So we help you with that internal plan so that you've given yourself a pretty big cushion to go out and beat and raise. Subscription-based model, easier to do, perpetual, monthly model, much harder.
The lawyers are never going to let you say perpetual.
Much harder to predict that type of model. So give yourself a lot of cushion into what you're giving to the public market investors at the time that you go out. Also think about the rate of deceleration of your growth. And this has a lot to do with value. Companies have been growing, 100%, 100%. go out with a model. Think about your model in terms of, as you get larger, that growth rate's obviously going to start decelerate. Investors really look at that rate of deceleration. So try to keep it, 150% to 100%, 75, 60, so that if you can flatline around 30, that is kind of best in class at scale. And I'm just saying that is the Salesforce model is 30% growth. That's what they've been able to maintain as a multi-billion-dollar company. But if your model is 150 to 50 to 25, you're going to get murdered.
Thank you for the question, and with that, we're out of time.
Murdered is my last.
That's
On
what I had.
better notes. A lot of opportunity out there for you guys.
So thank you to our panelists. This really is an all-star group up here. They're invested in Utah. They're excited about what's going on here. Let's give them a round of applause.